You'll get to know the 7 compounding assets that will keep your family rich forever. These assets also provide you with a passive income, so watch this video till the end to know them all. Now let's start. Number 1. Real estate properties. One of the most effective sources of compounded income for investors is the real estate marketplace. Rental properties present an excellent avenue for generating a steady monthly income. The steady flow of income from a rental property allows you to reinvest profits into additional real estate assets or other investment opportunities with relative ease. It is essential to recognize that a real estate property demands ongoing maintenance, and tenants will necessitate repairs, inspections, and various expenses that may arise unpredictably. Setting aside a portion of your profits in a management fund is essential for sustaining a high-performing rental property. This enables you to consistently contribute to your fund for managing expenses, as well as to your additional investments using the profits generated. Effective property management hinges on identifying strategies that enable your budget for the asset to achieve break-even or exceed that threshold. Number 2. Established companies' shares. The stock market is an arena that many investors are well acquainted with. Blue-chip stocks and dividend aristocrats represent some of the most robust companies available in the market. Consequently, they frequently serve as excellent assets to incorporate into your portfolio when aiming for compounded interest opportunities. Dividend aristocrats attract attention from investors aiming to benefit from the power of compounded interest. These companies represent enduring brands that have consistently raised their dividend payouts annually for a minimum of 25 consecutive years. In the U.S. stock market, you will find a total of 65 dividend aristocrats. Certain prominent brands consistently hold a significant position in the consumer marketplace. Procter & Gamble, Target, Pepsi, Walmart, ExxonMobil, and Aflac are all examples that fit this classification, but I'm not recommending you to buy these. Instead, you should do your own research to find the best for you. Subscribe to our channel and also press the like button to know more such assets. Number 3. Real estate investment trust funds. REITs represent a distinct category of stock assets within the marketplace, though there are other comparable commodities that correlate with resources like gold and oil. A REIT, or real estate investment trust, represents a collection of real estate properties that are traded like stocks, as defined by the U.S. Securities and Exchange Commission. Just as a corporation may possess assets such as a building, a fleet of vehicles, and intellectual property that enable it to provide products to consumers, and create brand value that attracts investors, REITs hold tangible properties that are leased to tenants. These entities are structured similarly to corporations, yet their assets are overseen in accordance with regulations established by the federal government. At its core, businesses allocate their earnings considering various elements, one of which includes the distribution of dividends to their shareholders. However, a significant portion of a company's profits is allocated towards expansion initiatives, employee bonuses, and various internal expenditures. Real estate investment trusts are required by regulation to distribute 90% of their taxable income as dividends. Number 4. Income-focused index funds. Index funds represent one of the most robust investment choices available to stock investors. Time highlights that index funds are a preferred choice for affluent investors, yet they are frequently overlooked by newcomers in the market. Numerous investors aspire to achieve significant returns by identifying a promising sleeper pick in an individual company. However, the likelihood of discovering the next Microsoft, Facebook, or Tesla ahead of the broader market is virtually non-existent. New investors, as well as those with extensive experience, are increasingly drawn to index funds and ETFs. These funds are traded in discrete shares similar to any other stock market asset. However, rather than acquiring shares of a specific company you have confidence in, with an index fund, you are investing in a share of bundled assets, akin to what you would find in the right marketplace. The assets accumulated within a fund consist of shares from various companies, however. When you invest in an index fund, you are essentially gaining exposure to a wide array of the overall market. Remember, this video is for educational purposes only. We do not directly recommend you to buy these assets. You must do your own research before acquiring these assets. Number 5. Index funds that prioritize growth. One effective strategy for generating compounded earnings is by investing in growth-oriented index funds and ETFs. Investment vehicles of various kinds are structured using a systematic or actively overseen framework of internal guidelines. The fund management establishes objectives and constructs a portfolio that is regularly adjusted to align with those objectives. Generally, there will be an earnings target along with guidelines for value preservation. This may involve holding a specific proportion of consumer staples, bonds, or FAANG stocks that have historically shown price movements at or above market averages, or that tend to outperform during market downturns. An ETF can be actively managed, whereas an index fund is generally structured around specific market parameters, such as proportional investments in each S&P 500 company or Nasdaq 100 tech firms, which are established and upheld for the duration of the fund's existence. Index funds typically come with low fees and have the potential to deliver strong returns over an extended period. There are various index fund options available that can align with your specific market priorities. The fund emphasizes growth potential, focusing on pricing targets instead of prioritizing dividend generation. However, given the extensive portfolios involved, dividend payouts will still occur. Number 6. Stocks. Investing in individual stocks can offer significant potential for compound growth over time. Instead of depending on a fund manager or an index to manage your portfolio, consider investing in a selection of individual companies that align with your personal objectives and financial aspirations. Managing your own diversification strategies allows you to customize dividends and overall growth metrics according to your specific approach and analysis. Choosing your own stocks allows you to tailor your portfolio to align with your individual investment preferences and goals. Consider incorporating index funds and REITs into your portfolio to benefit from their stability, while also allocating a portion of your investments to higher-risk assets that offer the potential for significantly larger dividends or the promise of substantial growth. It's crucial to consider the assets you add to your portfolio in relation to your existing holdings and any future acquisitions you plan to make. As you manage your portfolio, you have the ability to dictate the level of diversification and potential returns. However, it's important to be cautious, as there's a risk of concentrating too much in one asset class or a single company. Number 7. Allocating resources towards community enterprises. Another potential avenue for generating compound interest gains lies in investments in local businesses. This strategy offers a distinct alternative to traditional investments in the stock market or other commodity exchanges, yet it remains equally rewarding for those seeking a unique asset with strong returns. An established local business not only offers essential services but also contributes positively to your community, representing a worthwhile investment on multiple levels. In purely financial terms, Investing in a local business that is looking for a cash infusion can provide you with the potential for consistent dividend payouts on a monthly or quarterly basis. In the business landscape, allocating profits towards reinvestment can facilitate the expansion of service coverage, enhance product availability, or even introduce an entirely new range of offerings that meet consumer demand. Now, watch the video appearing on the left side to know the signs that show you're getting rich without even knowing. Also, subscribe to our channel to help us complete our goal of 11,000 subscribers.